From Argus Media, this is Driving Discussions, a podcast series that focuses on the forces that impact North American road fuels. Greetings and salutations once again. I'm Argus's U.S. Gulf Coast Blendstocks reporter Jason Metco. And on this edition of the series, I'm passing the baton over to one of our vice presidents of business development, Louise Burke. She'll be sitting down with Biofuels and Feedstocks market specialist Jackie Reigle, focusing on Argus's newly launched California renewable diesel spot indexes.
Thanks, Jason. Hi, Jackie. Welcome. It's great to have you here.
Hi, Louise. Thanks for having me.
Yeah, so renewable diesel, it's a popular topic in the transportation fuel space, and for good reason. It provides that lower carbon alternative fuel to petroleum-based diesel. And also, it as a drop-in fuel, it's very important for the industry as well. But additionally, there really are some large financial incentives provided by low-carbon fuel standards along the U.S. West Coast, the U.S. Renewable Standard, the U.S. Biodiesel Tax Credit, and potentially the Inflation Reduction Act. We see a lot of renewable diesel production capacity under construction or on the drawing board. So, Jackie, can you shed some light on what price indexes and metrics Argus has to provide transparency into the market?
Absolutely. So most recently on November 13th, Argus added California R99 head of the pipeline spot assessments, which will be the focus of our discussion today. But other offerings that we have include 4 calculations for different feedstock-based RD margin indicators at the U.S. Gulf Coast, and 8 California and Oregon R100 renewable diesel price quotes for potential reference and term deals. We launched the California R99 head of the pipeline assessments because it became clear the market was searching for an unbiased spot price reference. Around June, we started noticing that in California, where RD is heavily incentivized, and the top credit generator in the state's LCFS, an RD spot market head of the pipeline in LA and San Francisco was maturing and set to become more liquid as more capacity comes online.
Okay, so that's really interesting. And it sounds like these new indexes are going to reflect perhaps a Northern California and a Southern California base. Can you just describe a little bit the indexes and their advantages?
Yes, so Argus's California renewable diesel bulk indexes are market surveyed assessments that capture the spot value for head of the pipeline transactions of R99 at Kinder Morgan's Watson and Concord terminals in California, which receive RD by vessel and rail. The Argus indexes are published against both a NYMEX ULSD and CARB ULSD plus its attributes basis. Also importantly, the assessments exclude all credit value. And the advantage of these indexes is that they provide transparency to what has been an opaque market and help buyers and sellers understand the market value of the product they are transacting, especially in an environment marked by volatile RIN, diesel, and soybean oil prices. Understanding the price of renewable diesel in California is important because also the fuel remained the top source of new LCFS credits during the second quarter, rising by 14% from the previous quarter to 2.9 million tons of new credits and 16% of all new credit generation. RD basically crowded both petroleum and biodiesel out of the state's diesel pool for the quarter, making up a 54% of all California diesel consumed during the period. The second quarter basically marked the first period for RD to surpass half of the diesel supply in the state.
Yeah, I know folks have really been spending a lot of time monitoring that credit generation, and it certainly does look like renewable diesel is gaining in terms of volume and liquidity. And again, these indexes are really to help companies manage their margins and their cost and revenue. So can you expand on how the California head of the pipe R99 prices have been affected by the fundamentals you just listed?
Yeah, so head of the pipeline prices in California, they have been inversely tracking the D4 RIN BOHO spread pretty closely since June. Both the D4 and BOHO spread are directly linked to the blend economics for renewable diesel. The BOHO represents the difference between soybean oil and heating oil futures, and along with the D4 RIN can be used to gauge the practicability of discretionary renewable diesel blending. D4 RINs are, of course, credits under the US RFS program that are generated from producing renewable diesel. Therefore, the lower the spread between D4 RINs and BOHO on a cent per gallon basis, the less economic it becomes to produce and blend renewable diesel. So that spread fell from 0.5 cents per gallon on June 9th to negative 0.3 cents per gallon on July 25th, which represents almost a twofold decline. And during that period, R99 differentials in California head the pipeline. They were fairly robust, averaging an implied 13 to 19 cent per gallon discount against CarbUSD plus its attributes. But by August, with the D4 BOHO spread increasing, R99 differentials, they took a plunge, falling to average an implied 26 to 42 cent per gallon discount that month. Differentials have since recovered to beginning of June levels, valued between around 10 cent per gallon under CarbUSD plus its attributes. There's an inverse relationship between the D4 BOHO spread and R99 prices because as renewable diesel production margins deteriorate, producers are prompted to increase the level at which they can offer the product.
Okay, great. That's very interesting. So we want these indexes to be useful. Again, in the marketplace, when you look at commodities, it's important to have an index. So can you give us a sense of how you see these indexes being used by market participants?
Of course. So Argus California R99 head of the pipeline assessments, they can be used in various ways, and they can be used in contracts. Renewable diesel producers can use these prices in spot contracts and in contract negotiations with buyers. Also internally within organizations that can be used for transfer pricing. There's also risk management. Companies buying R99 can use this Argus independent index for mark-to-market valuations. There's optimization. Refiners, traders, and RD suppliers selling R99 can identify shortages / oversupply to manage production and maximize profits. And then, of course, there's analysis. Argus R99 indexes can be used to monitor the evolving premium to conventional diesel and as an input to price forecasts.
Okay, great. So lots of opportunities to use it and identify as a interesting tool to use for operational reasons, trading reasons, et cetera. So pretty exciting. So just in conclusion, I wanted to, highlight, what you said, Jackie, too, is that the rising supply of renewable diesel has really translated into some increase in RD spot liquidity. Just overall, historically, we've seen that in the last 10 years or so, between 2011 and 21, consumption grew from 1 million barrels to 28 million barrels a day. And of course, we do have that production database where we show that renewable diesel capacity, of course, can double by the end of 2027, 28, and increase to about 373,000 barrels a day. So very exciting. I think this growth is really triggering that need for additional price transparency. And again, these prices really do help indicate the market value for renewable diesel producers and sellers, and also the most competitive value, which is what we hope they can be used in the portfolio for market evaluations.
Great many thanks to Louise Burke, Argus VP of Business Development, and Jackie Reigle, Biofuels and Feedstocks Market Specialist. And with that, we conclude yet another edition of Driving Discussions, a production of Argus Media, a leading independent provider of energy and commodity pricing information. This reminder to check out the previous episodes in our series, and for more details on Argus's U.S. biofuels coverage, make sure you check out argusmedia.com/Americas-biofuels.